Hello, welcome to Module 4 of Personal Finance course. In Module 4, we are looking at financial planning as a GPS for your money. Think of financial plan as a GPS because it identifies where you are now. When you plan, it defines where you want to be and maps the most efficient route to reach your goals. Without a plan, people make reactive money choices, impulse investments, unnecessary debt, or ill-suited insurances that create missed opportunities and financial stress. That is why in this module, we break financial planning into actionable steps so that you can build a purposeful, resilient roadmap and take control of your financial freedom. So there are three financial planning pyramid. That is the order of operations. First, you have to do one before the other. Start with foundation, then at the middle you have wealth building, and at the top you have speculation and legacy. So under foundation, this is where your focus is on security and protection. That is, you focus on savings, for planning for emergency, and also insurance to protect against unexpected events. This must be built first to avoid forced liquidation or debt. So after this, you now move to wealth building. This is where you save either for retirement, you involve in disciplined investing, and use tax advantaged accounts to grow assets over time. Then at the top, although it is the smallest, at the top is involves speculation and legacy. You move to this step of operation if you have secured your foundation, if you have built wealth. So at this top, you invest in high-risk jobs or high-risk businesses with spare money and estate planning to pass wealth on. Okay, so at this stage, you can only invest money that you know you are willing to lose. So you can put it in high-risk uh, businesses. So, but this you will do when you have set up your foundation and you have also built wealth. So, what is even emergency fund? The emergency fund is your rainy day money. Your money for in case of job loss, medical bills, car or home repairs. So, for instance, if you are receiving any income, you have to open an account or a savings that is tagged emergency fund, where if it is in Nigeria, for instance, you may be dropping 500 naira every month, to for in case of emergencies. So financial experts recommend 3 to 6 months of living expenses in a safe, accessible savings account. You are saving it for 6 months, not to be invested, but so that it can help you avoid high interest debt and forced asset sales. So why the insurance matters? Insurance is a part of the foundation uh, in the financial pyramid. Insurance transfers large financial risks to a company in exchange for premiums, protecting against events that could otherwise destroy finance. So it can cover, we have what we call health insurance, auto insurance, and life and disability insurance. Health insurance will cover doctor visits, hospital stays, medications, and emergencies. But for auto insurance, it covers vehicle damage, injuries, and liability after accident, while life and disability insurance protects income and dependents. Terms covers a period and permanent lasts a lifetime. It is permanent and lasts for a lifetime. So these insurances are very important before you begin to talk about building wealth. So wealth building is, like we say, focus on long-term accounts. It's good you start early. You begin to save early. This will help you to begin to build wealth. You save early, you invest. Invest early enough. So this is where you build your wealth. Then at the top, like we mentioned, is where you involve yourself in high risk, such as maybe decide to go into speculative crypto. You are not so sure of crypto. You see, this crypto, you are not sure. It's just coming over. Let me try putting in 5 million. naira or 5 million US dollars. You can you may safely do so if you have emergency fund and if you have built your wealth. So even if the money goes, you will absorb the situation. It will not bother you so much. So there are 7 steps to your planning, and you must take this serious. Number one, understand your current life. You have to assess your life. What are the incomes? What are the expenses? What are the savings or debts? Also look at your life circumstances and do this honestly to find out your strengths and the gaps or your weakness. Number two is set financial goals. Use SMART framework to set your financial goals. And number three, analyze your financial path. Compare your current habits to your goals. Begin to identify shortfalls and prioritize changes. After that, you can make recommendations. Like you set detailed actionable steps. For instance, I will increase my savings, or I will reduce spending, or I will buy insurance, etc. So number five is, after you have created those actionable steps, share it. Discuss the plan with a partner or stakeholder to ensure shared commitment and clarity. Then, after sharing it, you go on to implement it. Maybe those actionable steps may involve opening accounts, automating transfers so that as money is reaching your account, banks are taking it automatically, or you follow your budget or start regular contribution. Then, final number seven is always monitor and update. Review your plan at least annually or when life changes. Adjust goals, contributions, and strategies. Now, what I mentioned smart setting smart goals. What are smart goals? Smart stands for specific, measurable, achievable, relevant, and time bound. It means any goal you are trying to set, it must have these characteristics, it must fall within this framework. That means the goals must be specific, it must be measurable, it must be achievable, relevant, and time bound. But this will help to turn wishes into actionable plans. For example, I want to save 20,000 US dollars by December 2027 for a house down payment. When I do that, I will now begin to compare it with the time horizon. So I'll prioritize goals by time horizon. It may be short term, long term, or medium term, as the case may be. So when you combine SMART with those horizons, it will help you to allocate resources wisely. So always set SMART goals and time-based planning. So let's look at financial life cycle. For every person's finance or financial life, there are three phases that finance goes through. First, it starts with accumulation. This is where you grow assets, you maximize contribution, you save. Okay. Then the next, it moves after you have saved, you are gathering money. You move to preservation. This is where you reduce risk. You go into strong insurance. You protect your savings and you invest. Then the third phase is the distribution phase, where you generate income, you manage withdrawals. This is where you begin to invest more from the money accumulated. You begin to invest and you begin to manage your withdrawals. You are careful in how you withdraw. This life cycle is guide strategy by age and goals. So accumulation focuses on growth and compound interest, right? While preservation reduces risk and maximizes retirement contribution, while distribution manages withdrawal to make savings last while considering taxes and healthcare costs. So adapting to these strategies by phase helps maintain security and meets your changing needs. So these are practical steps you can use. This checklist will help you. First, you have to calculate your net worth. Then number two, audit your spending. Check how you spend your last month's transaction. Find saving opportunities and pick the one area that you need to improve. Then number three, start your emergency fund today. Begin to plan, you know, for emergency. You may not start with 500 naira or 500 US dollars. You can decide to start with one lesser than that, depending on your situation. Then number four, check for insurance. Review your health, auto, life, and disability coverage. Confirm your beneficiaries and adequate limits. Then automate your system. This is important. Set automatic transfers for savings and retirement. You can do that in the bank. Just visit a bank at the end of the month, you remove, say, 10,000 naira from my account. It is going into my savings or retirement. So when you go to bank and you fill those forms, you see that as soon as money enter your account every month, it will automatically, that specific amount you stated will be automatically deducted. So this is what this module is about, how you plan your financial life. So thank you for listening.